last 2 weeks alone, 3 new AMCs have received their license from market regulator SEBI to begin operations in India, taking the total number of mutual fund houses now to 47, and there are still many more big names in the pipeline. So how does an investor judge a new AMC? What is the credibility of the sponsors, the trustees, and the promoters? Next comes the track record of the main group, the existing line of business, and whether there is any potential conflict of interest. These are factors which should have also been vetted by SEBI while giving the license. Next, an investor must check the key fund managers and their experience and qualifications, as well as the kind of service and operational setups the fund house has in place. The positives here will be that the new funds will have to perform. So you'll know they'll be putting in that extra effort to get things right. Since there are no legacy issues, they will have the space and ability to experiment in their portfolio. And there's no doubt that they will be operating on and with the latest technology. On the flip side, there is no track record or pedigree to fall back on. For the lay investor at least, their ability and intent will remain unknown for quite a while till they can prove otherwise. They will carry the burden of increased expenses and costs if they are unable to generate critical volumes or gather sufficient assets under management, as smaller size schemes will generally have higher expense ratios. And the initial cost of distribution will be higher for the same reasons. As well, performance pressure can very well lead to unwanted risks in the portfolios. For debt funds, it is always better to go with larger existing schemes. Since the fixed income returns are smaller, bigger schemes with lower transactional costs and better yields on bonds will do better. As well, bigger players have better leverage with companies when it comes to new issuances, and a larger AUM will also help in better diversification across issuers. It may happen that a smaller sized fund can face concentration risks. However, new schemes can be considered if the theme is very compelling or new, and if the player has a solid track record of handling niche areas of debt like credit. When it comes to equity funds, the track record and ability of the fund management team is the key criteria. An investor must be able to judge how well an AMC sticks to its defined processes and stated objectives. For a few categories like ETFs, high volumes and bigger AUM could be critical. Many savvy investors may choose to follow the fund manager from an existing scheme or AMC to their new role if they are convinced of their abilities. A smaller AUM can work in categories like mid or small caps or even sectoral or thematic funds, as a newer player will have more flexibility to test new ideas. Several times, established AMCs may go about index hugging to safeguard AUM. So new or old, when it comes down to adding something to your portfolio, goal-based asset allocation is the only one mantra to follow. Buy it only if it is aligned with your investment philosophy, with your portfolio.